Good evening, everybody. Welcome in. Morning, Helme. Apologies if I sound a little different. I'm just getting over being sick, so I'm not quite sounding completely normal, even to myself. So hopefully it's not too annoying. What's going on, everybody? Good evening, Husky. Happy to see you. Always a regular. Oh, thanks, Gail. I appreciate that. I feel honestly pretty good. It's just I don't sound that great, so I'm either way excited for the class regardless. So no stress at all. What's up, Christian? Good to see you. We're going to get this one going here in just a couple of minutes. Just going to give everybody the chance to hop on in. Sent the link out a minute late, so I want to make sure everybody gets a chance to get on in here before we get going. Good to see you all, though. Sorry I took off last week. I was away from the desk last week, but happy to be back. We got two back-to-back classes tonight and tomorrow, so should be a good way to close out the week for lectures. At least that's the plan. Oh, you got the flu. That's a bummer. Yeah, thankfully I don't think I got that. Mostly just a cough and a little bit of a sore throat, but life goes on, man. Life goes on. Thanks, Nick. Great name, by the way. You loved last class. Awesome. So happy to hear that. Yeah, glad to see you returning. Yeah, this one should be good. I just finished up the PowerPoint for this one last night, so feel pretty good about it. Yeah, Johnny. Yeah, two back to back today and tomorrow. Yeah, so we're doing class 2 of the VPA series tonight, and then class 3 comes tomorrow. So I'll work on getting class 3 planned this evening. Yeah, excited. Looking forward to it. All right. Appreciate that right now. No worries. Even if you don't appreciate me, I'm still here. Yeah, this class one was posted. Let me see if I can go find it. Probably when we finish up the course series, I'll organize them all a bit nicer. But yeah, so class one is right here. So I can send you the link. The link is posted in this message right here. Yeah, if I can talk that a little bit at a high level, though. Every technique that we talk about in these classes are equally applicable on any brokerage, or I guess charting platform in this case. So it shouldn't be really any different. The only things that'll really change are like the specific things you're actually doing in order to, bring charts up and change colors of things and that sort of thing. But yeah. All right. Sending out one last message, letting everybody know we're getting started. And we will get right into it in just a minute. All right. We think we've waited long enough, a couple minutes after the hour. So let's get this one going. Welcome into the class for the evening, everybody. Again, apologies if you didn't hear earlier. Still just getting over sickness, so voice probably sounds a bit odd right now. So apologies for that. But tonight, we're going to get right into it. Last or 2 weeks ago now, we talked about the kind of introductory class for this volume price analysis series. Tonight, we're going to continue down that path. So I have a couple slides kind of explaining what we covered last time if you weren't able to make it. So let's just get right into it. A couple things to mention before we get started. As always, some of you may have heard this plenty of times before. This might be the first time some of you may have been to one of my classes, so I gotta still give this quick little spiel. Generally speaking, I do my best to structure these classes in a way where I'll call it simpler content comes at the beginning, and it gets more complicated as we progress throughout the class. Generally speaking, I do my best to structure these classes kind of like you might see like a college course or something like that. So hopefully you appreciate that structure and it worked for you as well. As always, if you have any comments, questions, concerns, go ahead and throw them in the chat, and I'll do my best to address them as soon as possible. And that's enough of me. Let's get right into it. So these lectures definitely are pretty heavily based in some of the teachings from this book. As I mentioned in the previous class, I'm not sponsored. I don't get any money to talk about this book. I don't get any recognition, nothing like that. But I would be doing a disservice to the author, Anna Cooling, without mentioning these concepts are all kind of explained in this book as well. So if you're interested, definitely go ahead and buy the book. It's pretty cheap. It's like $20 on Amazon. We're going to be expanding on some of the concepts from here, but this lecture is pretty heavily based off some of the examples that are given in the book. So yeah, definitely shout out to this book. And as a reminder of where we're at in the course, last week we started with the introductory class, and today we're going to talk about some more foundational concepts of volume price analysis. And again, as I mentioned, if you weren't in last week's or 2 weeks ago's class, I'm going to start this lecture off by giving just a quick recap to talk through everything, make sure we're all on the same page, since it's been a little bit. But yeah, as a reminder, it's a 6-course series. Today we're covering the foundational concepts, so some of the more kind of core concepts of volume price analysis. Tomorrow we'll start talking a little bit more about applications, so we'll start to talk a little bit about kind of how it actually applies to maybe a trade plan. The following class, we'll get to some more advanced concepts, so a little bit higher level, building on some of the concepts we talked about tonight. Finally, or in the 5th class, we'll talk a little bit about trading strategy, so really start to hammer down how to actually employ VPA into a trading strategy. So we'll talk through structuring trade plans, how to use VPA in a trade thesis, that sort of thing. And then finally, the conclusion class, I am imagining this to look a little bit more like a discussion rather than a lecture. So I kind of want us all to talk together about how we started to use these concepts and questions and that sort of thing. So we'll see what that ends up looking like. I'll do my best to prepare everybody before we get there, but that's where we're at in the course. As a reminder, the 2 main goals, number 1 is to develop successful traders who have a clear understanding of the fundamental principles of volume price analysis. And the second goal is to teach attendees how to apply the techniques of VPA to help traders create an excellent trading system. Excuse me. And as I mentioned, this is the first time this VPA course has ever been delivered in only options trades. So if you have any questions or ways we might be able to improve it for next time, definitely let me know. Yeah, happy to make any changes as necessary. So let's get right into it. Starting out with some of the slides that we covered in the last class. Those of you who are in the last class maybe forgot some things, and those of you that missed it maybe just need a little bit of a refresher, and that way you can go back and watch class 1 once we get through all this. So starting off, we discussed what volume price analysis actually is, and I think this is the definition that I stole from the Google AI, which reads, volume price analysis, or VPA, is a trading technique that combines the analysis of volume and price movements to understand market trends and predict future price actions. And as I mentioned in our last lecture, this is pretty vague, but it kind of doesn't need to be vague, because this really does encompass a lot of ideas, volume price analysis, that is. So this is the high level. Generally speaking, it's a method of technical analysis that utilizes volume in order to have higher confidence about price movements. So that's a big idea. We'll get a little bit more specific as we continue this recap. Oh yeah, another one that I mentioned, this was a cheesier slide. Last time I mentioned that the concepts that we talked about in this lecture series are applicable to every stock on every time frame for any type of trader. It doesn't matter what brokerage you're using. It doesn't matter what type of stock you're trading. All of the things that we talk about in these lectures are applicable to pretty much anything you're going to trade. Now, obviously, there's always going to be things that are caveats to that. But the big idea is that anything that you're really going to trade, you can use these concepts on any time frame, on any brokerage, on any charting platform, no matter what type of person you are. And that's the real power of volume price analysis. And we'll get into some of the more core concepts in just a couple of slides. One other thing we mentioned is obviously in a class about volume price analysis, it's important to define what the 2 terms in the kind of course are, which is volume and price. Price, pretty obviously defined as the price of a given equity or stock. Volume sometimes is a bit more obscure, which represents the amount of shares traded in a given time frame. So here at the bottom of the chart, we have volume bars, which represent the amount of shares traded in every one of these candlesticks. And you can see we're on the weekly time frame here. So each one of these candlesticks represents 1 week of trading activity. So as a result, these volume bars down at the bottom represent the amount of shares traded within that week. And volume helps us quantify the amount of buyers and sellers in the marketplace. So for example, when we have these green volume bars here, it's pretty easy to tell that these are weeks that were dominated by buyers. We have these big green volume bars here, which stand out from the average, which are significant for reasons that we'll talk about. And also, we can see when there's large groups of sellers in the marketplace, which are signified by these big red weeks, essentially. And this is a really, really simplified definition, but the big idea is that volume essentially represents the amount of shares that exchanged hands in a given time frame. So, for example, you could think of this as like if a store was keeping track of the number of meals they sold in the day, that could be represented as the volume of meals. Or like even simpler, if McDonald's is keeping track of the number of Big Macs that they sold in a day, that's the volume of Big Macs that they sold in a day. They might be keeping track of the volume of Big Macs they sold in a week or in a quarter, etc. That's all volume is it's tracking how many shares left somebody's hands and went into somebody else's hands. That's it. And it's a raw number, so it could be in the millions, it could be in the hundreds of millions, it could be in the thousands. So it all depends on the stock you're trading. Volume's all relative. Again, I'm not going to go into this too much detail just because we had all of last lecture to really talk about these concepts in detail. So I'm going to kind of brush over this at a high level for now. Finally, and really the most important part of last class is we talked about the laws of volume price analysis. And there's really 3 main laws of volume price analysis that help us understand what's going on in a given equity. The first one is the law of supply and demand. This is something that you'll probably hear or maybe have heard in like a basic economics class. Supply and demand are essentially groups of buyers and sellers. Sellers have supply of something and buyers want something, so they're in demand of something. So think about, for example, PS5s when they were first released. There was a limited supply of PS5s in the marketplace, but there was a high demand of those PS5s. So as a result, the price of those PS5s was higher than retail. And think of like gas, for example. There's a limited supply of gasoline at any given moment in an area, right? And that sets the gas prices for the entire area. And as demand fluctuates, gas prices need to be modulated in order to meet that new demand. So for example, during COVID, when demand cratered, when we still had a constant amount of supply, gas prices ultimately dropped because there was nobody willing to buy gas anymore. The next rule law is cause and effect. And I added this kind of extra definition here at the bottom. Volume is the cause, price is the effect. And we're really going to get into this rule today in this class and talk about what this actually means with some real world examples. But generally speaking, volume is what actually causes price to move, right? For example, price doesn't go anywhere if there's no volume, right? If there's nobody trading, there's no reason for the price to change, right? You can think of, I don't know, I can't even think of something. I guess a low volume stock, right? A low volume stock, the price typically doesn't change very much because there's nobody trading it. That's the simplest analogy I can give there. And then finally, another rule that we're going to cover today, or law, is effort versus result. And I think Isaac Newton maybe said this, which is every action must have an equal and opposite reaction. And while that is applicable to physics, it's also applicable to the world of finance, where in general, if we see a high volume candlestick, we would expect to have a big result as well, right? So for example, if a lot of buyers stepped into the marketplace suddenly, we should expect the price to go up pretty quickly, right? For example, that goes back into the law of supply and demand, where if demand instantly skyrockets, supply stays constant, well, the price has to go up, right? So that's effort versus result, which is also a concept we're going to cover in a decent amount of detail today with some real world examples. And even saying these laws out loud, I can understand how maybe they're a bit vague or hard to picture, which I promise as we go throughout this lecture, they should become infinitely more clear as we're going to connect these rules to some real world examples in just 1 or 2 slides. That said, that's the 10-minute recap of what we covered in an hour a few weeks ago. Any questions, comments, or concerns on that before we keep rolling? As I mentioned, if you're interested in taking a look at the recording of that lecture, I'll send you the link to that recording here in the Zoom chat. So you can go ahead and access that at your own will. Yeah, those of you that were here in the last couple weeks or last week from lecture from 2 weeks ago should be pretty familiar with everything we talked about. So hopefully nothing is surprising here. All right, cool. Let's keep rolling. So now let's get into some new concepts for tonight. And this is going to be kind of the building blocks of volume price analysis, where this is going to be really the simplest tools of analysis that are going to be used to form all of our other concepts. So I just want to make it very clear. If you have any questions as we go through the lecture tonight, it's really, really important that you ask them, because if you're confused on these, you're going to be really confused on the next ones. During COVID, gas dropped, but where? Not here in California. Gas prices dropped in California. They went down to like 270 for a week or two. I was still driving. San Diego, they dropped, Giovanni. They went back up quick, though. That's for sure. All right. So bringing back one of our most important lessons from last lecture, volume validates price. And I said this in last lecture, I'll say it again. If you decide you learn nothing from these lectures, this is one thing where I highly encourage you to remember for the rest of your trading career: volume validates price. If we have a big move in price with no volume, that doesn't make any sense, right? And we'll talk about an actual term to define that in the future. Whereas if we have a big move in price with a big amount of volume, that's completely logical, right? And that signifies a strong, high quality breakout with a lot of buyers rushing in when it matters most. So let's talk about that. First example, we have a reasonably sized candlestick with, here, let me take a step back. So introducing what we're looking at on this graphic here, we have this purple line or red line, which represents the average volume for this given stock. We have this blue volume bar and this blue candlestick. This blue candlestick represents essentially a green candle or a red candle. It doesn't really matter. What really matters is it's a large candlestick with a wide spread, which, if you remember what we defined spread as, it's the distance between the open and close of a candlestick. So, for example, let's talk about some widespread candlesticks. If we take a look at Apple, this, for example, would be a widespread candlestick, right? It's massive compared to all the other bars on the chart. Whereas something like a doji here or here would be something that can be described as a candlestick with a smaller spread. And there's no specific threshold that really tells you, hey, this is a big candlestick, this is a small candlestick. It's really all just based on visual pattern recognition, but you can pretty easily tell those widespread bars against the smaller spread ones. Like, for example, this is a pretty widespread candlestick. These are obviously widespread candlesticks. And if you take a look at the weekly, it's even more evident, right? You can pretty quickly pick out our widespread bars here, 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 and here, versus the smaller spread here and here and here and here. So essentially, when I say spread, I'm really referring to the distance between the open and close of the candlestick. And as the open and close of the candlestick are further away from each other, that's a larger spread of the candle. So here we have high volume, which is far above the average, with a wide spread candlestick, which in this case, volume is validating this move in price, right? We have a massive move in price on high volume. This, for example, is something that we'd want to look for on something like a strong breakout. When we see a move like this, generally speaking, there's always, and I mean always, a higher probability of price continuing in that same direction. And you see this time and time and time again. And just going back to a couple real world examples here on Apple, here, a widespread candlestick on far above average volume. Lo and behold, after this candlestick, price continued appreciating another 14% in under a month. That's not a coincidence, right? And we see the same thing over and over again. Right here, we have a widespread candlestick on above average volume. And while we didn't go up instantly, this did signify a pretty massive short-term or longer-term low, right? We undercut this a little bit, but for the most part, this was pretty much the bottom, right? We didn't break any key levels on this candlestick, so a little bit of a weaker signal, but still, right, important. And here, conversely, we have a widespread candlestick on above average volume, right? Red candlestick in this case, and ultimately we got a nice continuation lower, right? In this case, 11 trading days for a 5% decline. That's pretty big for Apple. Same thing here, right? Another widespread candlestick. Again, another 10% decline for Apple in the period of 19 trading days. It's under a month. So the short answer is when we see, or the short story, I should say, when we see these widespread candlesticks on high volume, that typically signifies a strong breakout or a strong bounce. Always. So you always need to be paying attention for that. And this is something that people might teach as something to look for during a strong breakout. You maybe just never really understood why it matters. So talking about the theory a little bit and why this matters. Think back to our rule of cause and effect, or even supply and demand, right? In any given equity, supply is typically constant. And what I mean by that is the company issues a set amount of shares. So for example, if we take a look on Apple, and we go to the fundamentals, look up Apple, the total number of shares outstanding. Oh, nice. Thinkorswim says 0. So that means there's 0 shares. Nice. Okay, let's look at something else. Amazon. Nice. 0. Okay, Microsoft. Nice. 0. This is really working well. Tesla? Okay, whatever. Anyway, I don't know why this data is not loading, but the short story is every given tradable equity has a set amount of shares on the marketplace, which means supply is constant. And obviously that can change, right? A company can do buybacks, which takes their shares off the marketplace, and companies can do offerings, which places more shares on the marketplace. But let's forget about that for now and just say supply is constant in financial markets. In that case, all we have to look at is demand. So if demand goes up, price goes up, which is great, right? So if we're not even looking at this volume bar, we can see that demand during this period for this given example went up, right? For some reason, more people wanted to buy a given stock for whatever reason, right? It could be 1,000 different reasons. However, that increase in demand is only important because we also have high volume. And if you think back to our introductory lesson, a lot of trading used to be done in person. So for example, people would be in the NYSE, brokers would be trading there, and they'd be yelling and screaming to buy, right? And that would be people's way of determining how badly people wanted in a given stock, right? That was literally a trading strategy, is people were looking and paying attention to how aggressive people were on the trading floor, and they would use that to understand if a stock was making a strong move, right? Which at that point, it's pretty simple to think about, right? If you hear a bunch of people yelling about something, well, it actually might be a little bit more important, right? And you could extrapolate this to a lot of things in life, right? If there's a lot of people yelling, you might be one of two people. You might be the type of person to run towards it or the type of person to run away from it. But either way, you're paying attention, right? Whereas if something's quiet, typically there's not much of a reason to be paying attention. So hopefully that analogy helps. But in this case, you could think of this high volume as people yelling and rushing to get into a given stock, right? Which means something has fundamentally changed in a given equity, which is resulting in large groups of people stepping in to buy at whatever price, right? They no longer care what the price is. They just want in because it's so important for them to buy in that given moment. So ultimately, this was a long way for me to say that when we see this widespread on high volume, it indicates aggression, right? People are aggressively looking to buy or sell a given equity as soon as possible. They want in, period, end of story. And this is a signal that we want to see when we're looking for a strong breakout, a strong hold of support. That makes sense to everybody. All right. Very nice. Let's keep it going. Here, we have a different example. We have our same average volume line here in red or brown, or I can't really tell what color that is. I think brown. We have a narrow spread this time, so a very small distance between the open and close of the candle. And to couple that, we have low volume, which again, thinking back to our rules, right? If we take a look at price, we know that demand is relatively unchanged over this period, right? The open and close are pretty close to each other, so people just don't really care. They're happy with their position, whether they're a buyer or a seller. They don't really want to buy or sell more. They're just content, right? which that's fine. That's not necessarily a reason to take a trade immediately. However, it's important to know that this is also coupled with low volume. So we've gotten a very small move in price, which is coupled by very little trading activity, which, as we talked about earlier in this class, completely makes sense, which again, volume is validating price. If we see a little bit of volume, we should expect a smaller move, right? You could think of the small amount of volume as people not really yelling on the exchange. People are patiently walking up and saying, yeah, okay, I want to, buy some shares, right? I want to get some shares, right? I'm not yelling, I'm not freaking out about it. Say, hey, can I buy some shares of this? And you're the only person that buys that day. Or maybe you could think of like a lemonade stand tucked away in a quiet neighborhood, right? There's probably not going to be people handing in money hand over fist to buy the lemonade. It's just not in a good location, right? So this is that exact example where not really much has changed in the price of the stock, but not many people buy or sold. So it makes sense, right? There wasn't much trading activity, so there wasn't much of a change in price. Perfect, right? That completely makes sense. In which case, volume is validating price once again. We have a couple questions in the chat. So Nick says, so based on this, then it explains when a company splits, then the ticker moves slower because they have been oversaturated, which means they have too much supply and not enough demand, correct? Yeah, that's a case that I really didn't want to talk about, only because it does have some caveats. So the reason that actually shouldn't technically make any changes in how the stock trades, because the supply is being multiplied by X dollar amount, right? Or X amount, right? So if you're doing a 10-to-1 split, supply is being multiplied by 10. However, the buying power let me explain this, right? If one person wanted to buy one share pre-split for $1,000 a share, they have that demand, right? They want to buy one share at $1,000. Perfect. When that ticker splits 10-to-1, in theory, the price stays the exact same. So there's now 10 shares priced at $100 instead of one share priced at $1,000. So in theory, that same buyer who is willing to buy one share at 1,000 would still be perfectly willing to buy 10 shares at 100. So in this case, supply and demand kind of changes proportional to each other, which in theory should create no net impact in price. Now, with that said, that is typically not how it actually plays out. So there's some more complex market dynamics that are at play. When a company splits, it's really common to see demand actually increase before the split, because I think there's typically speculation that, okay, if the price is getting lower per share, demand will go up by people that can't buy $1,000 share. Like smaller investors can buy $100 shares. Also, I think typically we see just more hype around stocks that are splitting. Like think of your Nvidia, think of your Tesla when it was splitting in 2020 and 22. Those stocks typically are doing well when they're set up for a split. That's the big idea. And there's, I'm sure, more complex market dynamics that we could get into. But the short answer is, in general, supply and demand shouldn't change in theory based on a split, but it does based on external factors. People just want to buy more because of the split. It's not necessarily because the share count is changing. Does that make sense? Gail, that's a great question. What should you look for volume, 10,000 or more? When I am scanning for stocks to trade, typically I look for stocks that trade at minimum 1 million volume a day. But it's important to note that volume is super, super arbitrary. It's all relative. So for example, high volume on something like Apple is, I don't know, 100 million-ish, 100 million shares. But if we look at something like Shop, which is less traded, high volume is 40 million, right? Or really high volume is 60 million. So it's a little bit different there. So that's kind of the big difference is volume in general is a relative comparison. You can really only compare high or low volume to the individual equity that you're looking at the volume on. So that was a little bit of a roundabout way to explain that, but hopefully that made sense. Is the second example just telling us that volume validates price, or is there something else it's telling us? Yeah, so there is a little bit more. Again, right? volume is validating price here. Absolutely, right? We have a small, narrow spread on the candle with low volume, which means not much changed in the demand, which there is nobody really causing that change anyway. So it makes sense. As I talked about here, right, the prior slide is something that you'd expect to see on something like a stronghold of support or a strong breakout, right? This is what you want to see, a high volume, huge spread candle. This indicates massive strength, and this could be to the upside or to the downside. This type of candle doesn't indicate weakness necessarily. It just means that people aren't really changing their position, right? So this doesn't mean that the stock's going to die instantly. It just means that nothing's really changing, which is analogous or synonymous to consolidation. So this type of bar is something that you'll want to see on a strong breakout. This type of bar is something that you'll want to see after a strong breakout, because typically stocks don't go straight up, right? For example, something like Apple. It did go straight up for 2 days, but after that, it began to kind of cool off a little bit. And while volume was still high, it was significantly lower than on these two breakout bars. And we start to get some smaller spread candles in comparison, right? These are still big spread bars compared to these two, or compared to the rest of Apple. But just comparing it to this specific breakout, we get two massive spread bars on really high volume. Then pretty much volume just kind of chills, a little bit above average still, but reasonably high. And the spreads of candles cool down, right? So they start to shrink in size as we get into the moving averages. So this is all what we want to see after a breakout, right? Which is essentially the marketplace digesting that move higher. As you're probably familiar, nothing goes straight up or straight down. It never works out that way, except if something like a GameStop happens, right? Which that's a rare event. Excuse me. That said, we want to see that consolidation after breakouts, right? This is something that is very healthy in a move of a stock, right? Stocks trend. They don't go straight up. They move significantly higher, then a little bit lower to retest some areas of support below, right? Where previous buyers were present. We get a big move up, then the stock cools down a little bit, comes back into support, and then continues its move higher, right? Stocks have to find new buyers, and typically this is exactly the type of action we want to see after a massive historical breakout for something like Apple. This is a, 10% move in 2 days. I don't know the last time Apple's done that, but definitely, probably not in the last 3 years. Probably more than that. Maybe not even, it could be like pre-2012 type of move. So this is incredibly rare. So this is the type of action you want to see, just some small spread bars. Now, for example, if you saw a bar like this, I'm just making something up fake. You saw something like this after the breakout, right? On even higher volume than the breakout bars with a massive spread. Yeah, that's not a good look, right? That's no longer something that should be really exciting for you to enter. That's pretty nasty, right? So that's kind of the converse example there. Cool. And Christopher says, what's the yellowest volume bar mean? Yeah, so that's just a custom study that I have on. Essentially, it's just highlighting high volume. So it's computing the average volume plus 3 standard deviations. So it's all the normal volume. It just makes it really easy for me to tell when it's uniquely high. So you can see this is all 3 standard deviations above the mean. So it doesn't really occur very frequently. All right. So in summary, right, talking about our effort versus result discussion. Excuse me. When we see below average volume, we should expect a small candlestick spread. If we see average volume, we should expect an average size spread. Above average volume, we should expect above average size spread. And you could kind of see that illustrated in this example below, right? The first candlestick of this example, and you'll just have to trust me in saying that these screenshots are from the same chart in the same time frame. This first bar is a pretty big red bar, right? It's actually the biggest red bar of this whole period, and it's on the highest volume. So that's pretty good. This next red bar here that's significant is this guy, which this is pretty solid, right? This kind of makes sense. It's a decently sized bar. it's after a big gap up, nice rejection lower, so it makes sense, right? Here, we have a big, large red candlestick, and it's actually a little bit smaller spread, so slightly an anomaly, but right into support, so it might be justified. Now, yeah, Helmy, you're getting ahead of us here. So what happens if we have something like this, where an above average volume candle has a small spread, or a below average volume has an average size spread, or an average volume candle has an above average spread? This is called a volume price anomaly. And it's a term some of you have probably heard me say before in different lectures, and I've never gotten around to actually defining it so officially and formally. This is where the effort doesn't match the result. So this is where you should probably take a step back and analyze what exactly is going on here. So Apple is actually a really good example of this, believe it or not. And I'm just going to clean this all up so we can see it very clearly here. Looking at this period, you'll notice one of the highest volume days in the entire year, the highest volume day. We have this right here. We have the highest volume day, higher than these prior two breakout bars, on 246 million share volume with an average size spread, right? It's not really that big of a deal. So what could this mean, right? The short answer is we don't always know exactly what these anomalies mean. However, it's a great reason to pay attention to a specific stock and start to look into the context a bit more. So for example, if we do start to look into the context a little bit more, we see we got this selling on 6/21, really high volume. I believe that was no, that's not correct. I don't think that wasn't options expiration, or maybe it was. I guess it has to be. I'm not remembering. Anyway, we got this high volume with an average spread, which means that this probably wasn't all sellers, right? Because if this was a whole bunch of sellers, we probably should have moved much lower, right? For example, when we get these high volume days and they're clearly all buyers, we move way higher, right? 10% in 2 days. But now we get this high volume and we didn't really go anywhere, right? We moved from the prior day's close to the next day's close. We moved down 1%, where previously when we had volume on the same kind of wavelength, we moved up 7%. And then at one point throughout the day, we moved up again, another almost 7%. But now we're only able to move down 1% on this amount of volume. That's pretty weird, right? So it's something to pay attention to, right? That's all it is. We don't necessarily know that it's time to get long immediately or time to get short immediately. But it's a great time to start taking a look at a little bit of the context and figuring out what's actually going on here. So maybe we want to start trying to define a trade around this. Like, for example, maybe, just maybe, we want to draw some fib extensions, and we notice that we came right into some pretty big support, right? The 50% fib from this breakout. Maybe we throw up the moving averages, and we notice, oh, we're just coming to retest the 10 and 20 moving averages. Maybe we look at the higher time frames and figure out what's going on, right? Which, in this case, doesn't give us too much information. Anyway, this is a volume price anomaly, which essentially tells us when something is happening that doesn't fully make sense, right? And I think now that we know what we do, it's pretty obvious that comparing this candle to this candle doesn't really make sense, right? We have a bar, again, a 7% increase in 1 day on 170 million volume. Then we have a 1% decrease on 250 million volume, which that doesn't really make sense, right? How could we have less of a result with almost 20 to 30% more effort, right? Remember, the amount of shares traded is the effort that buyers and sellers are putting in. And in this case, there's no coincidence that price continued 15% higher after this, which in hindsight, this is pretty clearly a large chunk of buyers starting a new position for whatever reason, right? And there's plenty of ways we can form a trade idea around this, right? Again, as I mentioned, when we see these anomalies, it's not a reason to instantly go take a trade and do something, right? That's not the idea. It's not like when volume's validating price, when it's pretty easy to tell what's going on. When we have an anomaly like this, it's important for us to take a step back and be a little bit patient and wait to react to price. So there's two ways we could trade this. Typically what I would like to do, and I'm getting into a little bit of the trade idea section, but I'm just going to mention it just to start getting us warmed up. Typically what I do is very simple. Mark the high and low of that anomaly bar and trade based off that. That's pretty much it. And let's look at the 5-minute from that day and see how things played out. So this was the anomaly right here. We had a 110 million share block traded right after the market closed. So even if you looked at this detail even more, it's even more important to tell that, hey, this is probably the significant spot, right? But anyway, you can kind of see how we traded off these levels, right? You just use them as essentially tradable levels. So here at the open, we bounced pretty much right off it, right? Not perfectly, but pretty much found support right there. The market's not perfect. And the very next day, lo and behold, we found resistance right at that same level, high of day, right? And if we look how we continue to trade off those levels, the next few days, they continued to be significant, right? As we break above that level at the open, we get a nice move higher. Let's see if we ever even retested it. We may not have ever came back to visit it after that. Okay, here we had some fun right at the end of the day, cracked right through it. Here, opened right above it, nice move higher. So anyway, that's the important thing to do with those anomalies is really just monitor how we're trading based off the levels we formed in that day. And you can even be a bit more precise here and see when the highest volume actually was, which we did in that case, found it was at 1 p.m. and mark the level off of that. Swing. So again, as I mentioned earlier, the yellow volume in my chart is really just showing high volume. So the reason it's yellow is it's like a highlighter. It's essentially highlighting the high volume. Exactly, Nick. And again, hindsight is 2020, right? I can go back on any chart, find a candle like this and say, look how you could have traded it perfectly, right? Anybody can do that. That's not the point. The point is anomalies are really just a reason for us to take a step back and wait for things to change, right? We don't need to instantly make a decision. We don't need to instantly say, oh, high volume, buy, high volume, sell. Like, okay, well, wait, volume's not validating price here. So let's take a step back. Let's wait a little bit, right? Wait for a daily close outside of this bar. So here, go ahead and get long, put a stop loss at the low of the bar, right? If you traded it like that on this daily close here, that's an 11% trade, right? It's perfect. What else could you ask for? See if we can find another anomaly. Here, right? Pretty small spread bar. We do have a gap down, so I'm actually not going to count that because while it's not shown in the spread, we still did get a significant move. So that's one thing to note is that sometimes a spread could be small. However, the result is still significant because of a gap. So that's one important red flag to note there. Trying to find a day with high volume with little to no spread, and I'm not really seeing it. Anyway, that's the big idea on how you can trade these is essentially wait for the market to react to these, right? Wait for the market to show you what actually went on this day. You don't need to instantly get long or instantly get short. Just wait for that range to break. So let's look at a couple specific examples, right? Here is a large spread candlestick. Here's our average volume. We have a massive spread on this bar with below average volume, right? So this is a volume price anomaly. We got a massive result, right? Back to effort versus result with very little effort, right? So that doesn't make sense, right? That's pretty confusing, right? Imagine if somebody that weighed 100 pounds started squatting 500 pounds and they did it easily. Like, well, that doesn't really make sense, right? How the hell did that happen? Something must be off here. We should probably wait to see if they can do another set or what, right? That doesn't make sense. Or imagine you saw a Toyota Corolla cruising, I don't know, 300 miles an hour on the freeway and they're barely on the gas. It's like, well, that doesn't really make sense, right? Let's kind of wait and see what's going on with that thing. That's kind of what's going on here, right? We got a massive result, right? Huge difference between the open and close price and pretty much insignificant volume. So this is a reason for us to be a little bit cautious, right? This is a reason for us to say, okay, we don't really have a good read of the volume on this name, right? It's not really making sense based on our system. So let's give it some time and wait for this range to break. Marina, do we consider these anomalies more relevant on the daily chart than smaller time frames? Yes and no, I'd say. Anything on the daily chart is always going to be more relevant, right? So for example, any analysis you do on the higher time frames always matters more than the lower time frames. However, depending on the trade you take, anomalies like this on the 5 minute could be critical to your trade. Critical. Like if you're scalping, this could be way more important on the 5 minute than it is on the daily. So the short answer is it's important on all time frames. It's always going to be more important on the higher time frames, but that'll depend on your trade. Cool. And yeah, Raphael, holiday weeks absolutely can work like that, right? And sometimes though, it's important to note that volume does follow patterns. So for example, on holiday weeks, volume is just going to be lower, right? That might not necessarily be an anomaly, right? Because that's actually on par with our expectation. So it's not always just cut and dry. Excuse me. Honestly, more of an anomaly would be a high volume week on a holiday week. That to me is actually an anomaly, right? Because on a holiday week, we're expecting low volume, right? If we're not trading a day or two, well, yeah, volume should be lower throughout the week. So for some reason, the weekly volume is higher than the previous week. Well, that's actually more of an anomaly than not, right? That's actually the real anomaly. So important to note again, volume follows patterns, and those can be anomalies as well. All right, so yeah, seasonality for sure. That can also play into things. So this is one example of an anomaly, and similarly, we have another example, right? So again, we have average volume, tiny little spread on way above average volume, right? And this is another weird thing. It's like, okay, we have a whole bunch of buyers or sellers here who pretty much got nothing done, right? It's like if you go to a construction job and you see 30 people working or standing around, one person with a shovel. It's like, okay, well, nothing's really going on here, but we got a lot of people working on this. Again, it's another anomaly. It's like, okay, well, let's just kind of wait and see, right? There's nothing we can really do off of this. We kind of got to just wait. Does that make sense to everybody? This is really kind of the fundamentals of volume price analysis. So we're going to start to build a little bit. Also, let's take just a quick kind of break here. How's everybody feeling about the lecture as a whole? I know we just started this course series. How are you guys feeling? Is everything making sense? Is everything presented in a way that works for you? Is there anything that we could do better for tomorrow? I'm planning on doing a bit more real kind of chart work, less PowerPoint tomorrow. Cool. I'm doing my best to give you guys the theory a little bit more than just showing you examples, right? Because any of you can go read this book, look at the picture and say, okay, pretty picture, I get it, right? Anomaly, perfect, I understand. But in some of these cases, it's actually important to understand why it matters, right? Because then you can apply these concepts to more than just these examples. Kind of like we mentioned with the holidays, right? Again, an anomaly is simply just something that's not normal, right? A volume price anomaly is when something happens when we're not expecting it. Okay, well, that it could be these two examples that we just looked at, but also if we have, let's say we had a week called International Trading Week where everybody was encouraged to trade. It was the best week to trade. Shares were on sale. You get a discount, gift card, whatever. You'd probably expect that to be the highest volume trading week ever. Well, what if the stock that you were trading had low volume? Like, well, that's probably an anomaly too. Unfortunately, International Trading Week I don't think exists, but I'll wait for one of you to create that. All right. Happy to hear you guys are feeling okay. Yeah, that would be pretty cool. And yeah, also, I always love to give a lot of analogies in my lectures. If I ever say something that you're like, I didn't get that, feel free to let me know and I'll try and say it in a different way. I know sometimes the things I say are a little bit weird. I don't have a script, so it's kind of just the first thing I think of is what I say. So if you ever have any questions about what I'm saying or you need me to present something in another way, just let me know. You probably aren't the only one that's confused. All right, a couple more examples to round it out. So putting this together a little bit, right? Now, we were just looking at patterns with one candle. Let's talk through what it looks like in a couple candles, right? This is a similar idea where we see multiple bars increasing in the size of candle spread, right? So the bars are getting bigger, 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 bigger. And on the way up, volume is rising, right? So this is an example, again, of volume validating price, but with multiple bars, right? We're seeing more people interested in buying as price goes higher. And this is a strong breakout. So for example, let me see, I'm trying to think of a strong breakout recently. I mean, probably Microsoft is a decent one. Let's see. Let's see. Remember that strong breakouts work to the upside and the downside. We didn't, not perfect, but still applies. So let me zoom in on the volume a little bit and kind of show you what I mean here. All right. So let's mark out this day's low level, right? Current day's low, always going to be an important level in any given equity, right? So we set this low on a decently large spread green bar. So clearly some buyers present here. Volume high at the open and tapers off during the day. That's completely normal. That's a standard pattern. Here, let's see how we reacted at this level. So, excuse me. As we came into this day's low, we start to see volume increase, which as we're seeing volume increase, we're seeing the spread of candles slowly decrease. So we have an average candle spread, a little bit larger candle spread than a smaller candle spread. So size of the spread is decreasing as we come into support, which typically increases or means that there's buyers present, right? Which is signified by this lower wick as well. However, the very next bar, we break below that same low on still decently high volume. Then we consolidate below this low on average / dropping volume, right? This is not a big deal, right? This is pretty normal. We're getting these small spread bars below this key level with no significant volume, right? It just means that sellers haven't really stepped up in force yet. So for example, how you could have potentially traded this is two ways, right? If you were a bit more of an agile trader, you probably would have tried this long here at day's lows and either took the scalp or stopped out when we closed below day's lows, right? And as a trader that's scalping, you should be able to flip sides pretty damn quick. So when you see us start to consolidate below this day's low, well, you probably shouldn't be long anymore, right? And sometimes volume validating price isn't necessarily a reason for us to get in a trade, but a reason for us to stay in a trade. So for example, what we see here, we get this low volume consolidation under this key level. Then we get this nice rejection of that key level again on rising volume, right? Slight increase of volume. And then again, another larger spread bar on increased volume. Here we have volume validating price and also volume validating this breakout, right? We got this move below support. We held below support on average to low volume, right? Not a big deal because the bars are small. So that's fine. That's not a big deal. Then as the spreads start to increase in size, volume picks up, which is exactly what you want to see if you went short on a break below day's lows. And as traders, we should be looking for reasons to stay in trades when we're in profits, right? Obviously, you want to respect that stop. So that's number one. But when we're in profits, if volume's continuing to validate price, obviously take some trims, but we don't need to fully exit, right? Price is still moving as we would expect based on volume. And again, you could see, I mean, this pattern is like perfect. As the candle spread size decreases, volume decreases. Spread size increases again, volume increases again. Then we have this big green bar on the highest volume since, I don't know, 6:40 in the morning. Can't even clear the highs of this bar, right? We have all these buyers and they can't even clear the highs of the prior bar. We hold below this level. And again, the same pattern repeats, right? We set this new low. We break below on average volume. Then that first breakdown, right? Once we get that move lower, boom, volume steps up again, right? Then again, continuation lower, boom, volume steps up again. And you'll notice after these moves, we only continued to move lower, which this is a perfect example of volume validating price with multiple candles, right? This is exactly what you should be looking for. So you might be wondering, well, what if I didn't go short here? Oh, that's okay, right? There's obviously always a chance to find other entries. You pull up some of the EMAs, sometimes there's more opportunities to go short, right? This would have been the first, well, I guess this really would have been the first time to get a chance at re-entering the first test of the EMAs there. Same idea here, right? But you can see this concept is perfectly illustrated on a day like today, where you have a massively strong downtrend, right? Over and over again, every single breakdown is validated by more sellers stepping in. I mean, every single time. Look, here, we break these prior lows, more sellers again, every single time. And finally, we come into support, right? Finally, the price stalls in terms of moving lower, but we really don't go anywhere, right? You'll notice there's really no big buying bars, right? We're unable to clear the highs that we set from this bar. So there's not really a reason to go long, that's for sure. And it's still clearly in a bear trend, right? So being able to analyze volume throughout multiple candles really gives us the context and confidence we need to stay in trades and also be confident that we fully understand the trend. And a day like today is a pretty easy day to do this, right? You have the Qs down, 3%? Every big tech down at least 2 to 3%. So this is a pretty textbook banner day for a trend. And, the volume clearly is validating price here. Yeah, so my shedding for the EMAs, I use the 10 and 20 EMAs. Some people use the 9 and 21 EMAs. It's pretty much the same thing. Excuse me. So the volume is essentially just the number of transactions that took place, and the candle is the reflection of the price of those transactions. Yeah, exactly. That's a good way to describe it. The volume, we should be careful because one transaction can include X amount of shares. So I think you didn't mean that. I think you meant transactions by individual shares being one transaction. But just to make that clear, a transaction typically is 100 shares. Just common, right? A block of shares. So in short, the volume is representative of the number of transactions, and the price is representative of what happened during those transactions. Did the price go up? Did the price go down? So this is volume validating price, right? And this is what we want to look for in a strong trend day, right? Go look back at any trend day, do a little bit of homework, find a trend day where you feel like you missed out or whatever. I guarantee you're probably going to see one of these two patterns, depending on the trend, right? And this simply just indicates strength, right? This indicates that the trend is strong. I bet you if we look at Tesla on the 5 minute from a couple days ago when it was still moving higher, could have the same thing. Okay, I got to go back a little more. And again, I'm not trying to say everybody can do this. This is obviously in hindsight. Anybody can look back in hindsight and say, oh, look, you could have done. Not the point. These patterns repeat. I don't even know if this is really the best way to do this. I guess this is fine. A little bit less significant. This is more of like a single bar example. So here you have massively high volume as you break an important level, pre-market high, right? That's a pretty big deal. Here, oh, this is nice. Actually, a little bit of an anomaly. Oh, this is kind of cool. So not the example I thought it was going to be, but a bit of an anomaly, right? The highest volume since 650, but look at that spread. It's actually smaller than the spread of the previous bar. What does this mean, right? Well, if we put in a lot of effort and get a small result, typically that means the other side is stepping in, right? This is an anomaly, especially after a move higher when we see something like this. This is actually typically a short signal, right? We get a move higher or we get smaller of a move on more volume as we're pushing higher. That's typically a sell signal, right? And you'll notice, look at how this level behaved the rest of the day. This was the high of the day until the close, right? 2 more opportunities for a scalp off this level. And again, we're looking at the 5 minute, right? So this isn't going to be the most significant. This is just where I know to find the most examples the quickest. If you see that rising volume and candles, what is the maximum tolerance for us to chase? I mean, what do you think it is safe for us to chase on rising candles? Yeah, so you should really never be chasing in the pure sense of the word. In general, when you see those signals where volume is validating price in trend, you should wait for the trend to cool down and give you an opportunity to enter at a high quality level of support. Whether that's an EMA, a horizontal level, an SMA, a daily moving average, whatever it might be, a Fibonacci level, doesn't really matter, right? What you need is a high quality level of support to structure a trade off of. So when you see that strong move higher on a high volume, that's letting you know, hey, buyers are present, buyers are in control. And as we know, the probability is in your favor when you're trading with a trend. So yeah, like you said, wait for the retest, wait for the pullback, because it will come. All right. Again, as we talked about, right? Similar to our single bar anomalies, this is our multiple bar anomalies. If we saw price moving higher and volume decreasing, that's kind of suspicious, right? It's like, well, what's really going on here? Again, another sign for us to probably just wait and realize that we don't actually really know what's going on here, right? Effort is not matching the result, so we should probably wait for a better signal. All right. I remember what else I have. Oh, yeah. We are going to go over real world examples, which we already did most of that. How is everybody feeling about these concepts? Tomorrow, the plan is going to be to talk through a lot more examples. We're going to structure some trade plans off of these concepts. And I'm also going to combine ideas from other lectures because, as we know, one size, or I guess one thing isn't the end all be all, right? So just volume price analysis isn't necessarily all you need, right? You got to be thinking about a little bit more than that. However, volume price analysis can be really, truly a fundamental building block of how you trade because it's, in my opinion, pretty easy and it's so important. So important. How do you get the shaded part on your EMAs? Yeah, I have a custom TOS study. It's pinned in my tab. So that's how I get the shaded part between them. So I'll send you the link. In order to make this work, I've had a lot of people. I'll just send it right now. I've had a lot of people say they've had trouble with the studies. What you need to do is go into setup, I think, and then go into setup, go into open shared item, and paste the link I sent in the chat. And then you should be able to click preview, and then it just works. So you don't click that link because it won't work. Bring it into TOS, open the shared item, and then click import, and it'll work. Yes, and it only works on computer. At least I think. I guess I haven't tried it on mobile, to be honest. I know a lot of custom studies have trouble on mobile, though. So it probably only works on computer, but I haven't tried. All right. So to summarize what we talked about today, we recapped the concepts from the previous class. We discussed the significance of volume in different market conditions, and we reviewed how to apply some basic VPA in some introductory scenarios. Again, as a reminder, tomorrow we're going to do more applications. So should be a lot of examples that we're going to go through tomorrow. Maybe we'll do a couple little bit more kind of introductory concepts. We'll see, start to tie in some of the advanced concepts. Should be a fun one. That said, that's the end of it for the evening. Thank you guys so much for being here. As always, appreciate your attendance and hope you guys can all make it tomorrow night, same time, same place. We're going to keep this going. All right, everybody. As always, again, these classes are nothing without you guys attending live. I promise it would be so boring to say this, to do all this talking to myself. So I really appreciate you guys being here. Seriously, this is one of my favorite things to do in my whole life. So really appreciate you guys being here and excited to hopefully have you all back tomorrow. All right, everybody. Appreciate your time. Have a great night. Thanks for being with us.